Now, when it comes to the thought process of combining both these things, we understood there are elements which are required for high growth, and there are elements which are required for high quality, which is ROCE. Now, when you combine both, and when you start thinking about businesses, that is where the real magic lies. And in this segment, we'll learn about that magic and try to understand that with the analogy of a tree to just make sense of what this entire game is all about. So let's jump in and let's understand first of all the importance of ROCE, and then we'll understand the game of dissection. So what Charlie Munger said is, over a long term, it's had for a stock to earn much better return than the business which underlie it earns, right? If business earns 6% on capital for 40 years and you hold it for 40 years, pretty much you are going to make the same kind of return. And on the other hand, if you have a business who is earning, say, much higher return on capital, say 18%, and if you hold it for like 20-30 years, even if you pay higher multiple, you are going to make a lot of money. And that coincides with the Excel sheet which I've shared with you and discussed with you. Let me again show it to you, which I have given in the, I'll share it below the video itself in the recording. So this is what he is talking about. Like if you are just growing at 6%, you will not grow much higher than 6% compounding, right? So that is what is happening over here. Whatever is the underlying ROCE, the return on capital, that is what the company is growing. And if you think about business C, if you are reinvesting that capital and growing at 20%, over a long term, actually you are compounding at 20%. So this entire math is what Charlie Munger is talking about. And I'll be sharing this Excel below this video, so don't worry about that. Now let's understand the metrics. The metrics is called ROCE versus earnings growth metrics. So bottom is the earnings growth, and the basically horizontal is earnings growth, and the vertical is ROCE. And these are the types of businesses I can relate with. So on the top you have your banyan tree. On the top left, you have your mango tree. In the bottom, you have cactus. And on the bottom right, you have weeds. And in between, there is a palm tree, which you can see like palm kind of tree structure. And there is a bamboo tree in the middle of the mango and cactus, which is moving towards banyan. Okay, so let's understand this entire math, what I'm talking about. And let's try to make much better sense out of this entire concept. Okay, so let me share my other screen and let's draw this entire metrics so that we can understand this at a deeper level. So hope you should be able to see my screen now. And this is like the metrics which I have drawn there in the slide. So you have this ROCE at one end, which is quality, right? So return on capital employed, and you have earnings growth. Okay, so this is low over here, low earnings growth, high earnings growth, low ROCE, and high ROCE. So the best business is this business, right? So you have this business where you have high ROCE and you have high growth. So think of businesses like Astral and Pidilite and Asian Paints, which has high ROCE, and they are able to reinvest the capital on a continuous basis. So these are your banyan trees. And if you think about the structure of banyan tree, they take resources and they keep creating new branches. So they keep on growing themselves, and ultimately you will not be able to figure out which is the main branch. Okay, so they are reinvesting that capital also at high ROCE, and they continues to expand. So whatever resources you give to them, it basically uses it for future growth, and they become stronger and stronger day by day. That is banyan tree. Now, most of the business which are banyan tree, these will be expensive in terms of valuation. If everyone knows this is a banyan tree, do you think it will be a premium valuation? Yes or no? It will be a premium valuation. So what happens if you buy them in bull market? You end up paying much higher premium. So you might pay like 80p, 100p kind of money to these businesses. And it might happen that 2-3 years, even though this compounding is happening, you might not get return because your entry price is much higher. So if the businesses keep on compounding over a long period of time, as Charlie Munger said, you will make returns, but initial 2-3 years you might not make returns because your entry price is much higher. So how to play this? You basically take a tranche over here, okay, and then keep averaging up. Okay, so as the business improves, as the price increases, both coincides. That is where you add the business, so that even if you have added at a higher valuation, you are not going all in. And this should be part of your core portfolio without doubt. And that is what is the exercise for today. Now, suppose you are lucky and you buy it at during the recession. That's the great time to buy. Now, there is a big risk in these businesses. Can you think about what is the risk if you end up buying these businesses at a higher valuation? If you are holding it for short term, like if you are holding for 1 year, 2 years, there is a risk because you might not get any returns for 1, 2, 3 years because it's fully priced in. Another risk is that if there is a earnings degrowth, like market was thinking this is like a Shah Rukh Khan and it becomes like a duplicate of Shah Rukh Khan suddenly, right? So it was high growth company, but it comes over here and the growth becomes lower and it becomes Mango. Then market will say we are not going to give that same PE multiple. So your multiple will go down and your earnings is also going down. So you have little margin of safety if the degrowth is there. So people who say okay, you just buy and hold these kind of companies, stay away from these people, because you need an exit strategy if there is a business deterioration in these kind of companies. And before fundamentally the results will deteriorate, it will come on the price action. I'm not saying you monitor it on a daily chart or a weekly chart, even a monthly chart is fine, but you need an exit strategy out there. And I'll give you a very easy framework, how to think about it. So to think about a business, if it is, these kind of banyan businesses, what you need to see is on any chart, it is like a quickest shortcut. Without even going through the fundamentals, you can at least in principle say that this is a great business or not. So go to a monthly chart and open any kind of such companies. Okay, if I open Asian Paints and if I try to draw this 45-degree line, okay, if the line is exactly almost like 45-degree, most likely it is a banyan company. Okay, and it will not trigger your exit. Like if there is a degrowth, like think about La Opala. Okay, in 2016 it started degrowing. What will happen is it will grow for 45-degree like this for that much period, and then on a monthly chart it will start giving you trigger of exit. So you need to exit somewhere here. Okay, we'll learn about it in stage analysis and buy and sell system, which we'll have in hackathon, future sessions of hackathon of 4 and 5 hackathon. But right now you need to think about this. Okay, so it can be a 45-degree, but then it can go under degrowth and you see the kind of returns it has generated after this. So it was 343 rupees in 2015. In 2019, it is 137 rupees. So this is an example where your banyan is turning into mango. So you need exit strategy even in your core portfolio. If somebody says you don't need exit strategy, it's totally wrong way of thinking. Okay, so this is like other way around. Now there is a possibility of companies which are in red zone. This is like red zone where you have low growth and low ROCE. Now you understood the math in the Excel. What happens to these businesses? They don't compound. If you hold it for 10 years, will it make money for you? Like 100 to 159, we just saw the example, right? And if you put it in a FD for 10%, what will happen? You will make much more money. Okay, so the more you hold, the more it will suck money out of you. So if somebody says that you buy any company and buy it for long term, you stay away from those guys. Because any company you cannot just buy and hold for long term. It's like the more you hold these kind of businesses, the more wealth it will destroy for you. And these are like negative 45-degree, like downwards, like Unitech, Suzlon, those kind of businesses. When you open, you will see a downward 45-degree. Okay, so you should never hold these kind of businesses. And then there are even bit more, crazy kind of businesses, which are your weeds. So weeds keeps on growing, even if they are making low ROCE. So these are like those businesses which don't give out dividend. I showed you in the Excel also, the Excel B kind of businesses, right? Which are reinvesting, although they are putting 6%, they will destroy your wealth. Right? So this was reinvesting. Yeah, this is the example of reinvesting. This was the cactus, which is giving out as a dividend. Okay, so cactus is still better than weeds, which is growing. It will destroy even more wealth if they grow faster. Are you getting me? Okay, so these businesses will destroy your wealth. So don't get into these businesses. With me so far? Now let's come to the part. So basically, you don't need to be here in the weeds part or cactus part. When you should be into the weeds or cactus part is either the cactus is turning into mango. So they had low ROCE, but now because they are improving, their management is changing, they become high ROCE business. They are going into mango, which I call bamboo. Okay, this is a bamboo style of investing. So it is becoming better, and now suddenly the growth is coming in terms of ROCE. Or it could very well go into the banyan phase also. Or from mango to banyan also it is growing. It was high ROCE business, but growth was not there. But suppose due to some reason, the growth starts coming in. So bamboo is one where either you are moving from low ROCE to high ROCE, or you are moving from high ROCE but low growth to high growth, or you are moving both. Like high ROCE you are moving and high growth you are moving. From cactus you are straight away trying to become banyan. Again, I'm not saying it will be proven businesses, because it takes time for any business which was cactus for a long period of time or mango for a long period of time to become banyan. So this transition is captured by our ride winners tool. Okay, so ride winners tool, what we try to do is we check the price volume action, and we take a tracking position, and it will be satellite. Okay, so your cactus to banyan or cactus to mango or mango to banyan ideally should be tracking position initially. You take 0.5%, and this should be part of your satellite portfolio, not in your core portfolio. And then let it prove, give it 6 months, 12 months, 2 years, until that you put it into satellite. It is like a different mind frame to play that game. Because suddenly, something happens, it can again come back to cactus. And that is where you need tighter exit strategies out there. How many of you are now able to relate this with core satellite concept, like why we do what we do? And then there are mango businesses, which are pretty much, just staying there. So it's like in Excel, if I show you, this is the kind of business which is category D. So category D is more like a mango, which is not able to reinvest. So you will find these kind of company which is at best protecting your capital. Okay, and you should have these businesses in your core portfolio only when, if you are high risk cover, senior citizen, you want some dividend payout, you don't want too much of growth in your portfolio, that is where you can have it. Or you see that these kind of businesses are having some growth triggers ahead of them. So right now it is mango, but it can go into high growth trajectory. Okay, so your all Nestle and all those are almost like in that mango category, which gives out big dividend. And that is where the mango is very important, right? Because these businesses give you big dividend. Just give me a second. A big dividend, but then the growth is missing. So don't run behind dividend just to do that, right? So if you open up a 5-year or smaller time frame chart, you will see that these are stagnating, right? So when either it is too much of re-rating that has happened, or the growth is missing, it will stagnate. Even business like Castrol is that kind of business. So if you see business like Castrol, like almost not going anywhere. In fact, they are dying. Actually, their industries is also dying. So that is where you see some bit of downtrend also. With me so far? So that is the execution of the earnings growth and the entire decision making process. So in essence, if you think about it, there are three things which you need for your compounding engine to work. You need consistent high sales. Why? Because sales growth is a ultimate trigger that will continue for a long time, and profit growth. And along with profit growth, you should have high ROCE. And this high ROCE should be coupled with reinvestment of capital, not like business B, which is not able to reinvest. So how to see this reinvestment in the operating activity cash flow? If you see there are cash flow going into new investing activities, that is how you see it. Okay. So that is on this entire piece. I'll show you example in the next segment, but hope it is clear so far in terms of what to buy, what not to buy, why not to buy. And if you are super clear, as usual, just write the top three takeaways of this particular session, this particular segment, where we discussed about the types of businesses, we discussed about the relationship between growth and ROCE, and how this bamboo will play out. And also the palm tree is more like cyclical. So palm is basically moving from cactus to banyan. It appears like banyan, but comes back to cactus. So it is more like cyclical businesses. Your sugar sector, paper sector, steel sector, all those are palm trees. Okay, which people will start talking that as a structural story and all those things, but ultimately, they will come back, because of the nature of the sector. Okay, so they'll go into low growth, low ROCE, again they will grow to high growth, high ROCE, again come back, and they will have transition. That also should be played in satellite, because you need a clear exit strategy there. If you just keep buy and hold, you'll not make any money. And when you do hackathon stage analysis session, you will understand what I'm talking about. There will learn about the entire cycle and how to think about it. Okay, so now hopefully it is super clear. And now in the next segment, what we are going to do is we will understand how to practically apply all these things, how to connect the dots, and how to implement this entire thing, and how you need to create a screen. Okay, so let's jump into that. Okay, I can see banyan to be averaged up gradually, cactus only for risk averse investors. No, cactus you should not buy. Cactus you should only buy when there is a growth trajectory potentially coming in. Okay, so only when it comes into your ride winners and you see price volume action, and then you apply the 4-cylinder model to figure out where the growth might be coming, that is only when you should buy cactus or weeds, or even mango for that matter. Okay. Yes, exit strategy for core also required. CDSL is a mango. CDSL is not a mango because it has a structural growth story behind it. So it is more like a business E, which can grow without capital. Okay, so it's not actually a mango. It's beyond banyan. So without even taking any resource from the ground, it can grow, and it can give dividend back to the shareholders. Okay, so all these businesses which grow without capital, these are very powerful businesses actually. Okay, awesome. So hope you are getting it. Now next 5 to 10 minutes will crack this remaining portion, and I'll tell you what you need to do in terms of homework also. So 5 to 10 minutes will take it more. Are you all still excited? You are super clear so far? Just type super clear so that I know that you are following it. How to categorize ITC? It's at best mango. Predominantly the cigarette business is mango, and whatever remaining they are doing in hotel and all that is cactus. Okay, so they are not even cactus. It's like weed portion. It's weed with mango actually. Okay, so it's like 80% mango and 20% weed, what they are having as a business. Okay, so that is what they are doing. So they are pumping money into a bad business basically. That is not what shareholders like. Okay, so let's jump into the next part, where you learn the finale is coming up, and I'll tell you what to think about the entire thing and how to think about this entire checklist. Okay. All right. So we have now cracked the machine formula, and what we'll do now is try to practically apply this. The two things which you need to learn. One, in terms of checklist, what all things you need in terms of checklist, you should be super clear. So I'll save this checklist again below this video also, but this is the checklist you need to follow for your screening process. See for a long-term sales growth. Like if there is a sales growth for like 5 years, 7 years, 10 years, that is what you should be looking for. That will suggest that it is a long-term mega trend. See for margin profile, like at least 10 to 12% margin on a consistent basis suggests that it has some competitive advantages. And if it is an improving trajectory, you know that business is improving. So C and I is what you get there. Net profit net margin profile again gives you idea about competitive advantage. Earnings growth, NI and mega trend, all these three combined, it will give you the idea of earnings growth. The ROE, ROIC screen will give you idea about whether it is a high quality or not. Think about pledging. If a promoter has pledged too much of their shares, you know what action management is taking on the negative side. If they have too much of debt, that is a negative action. Interest coverage, right? So if your interest coverage ratio, like if whatever EBIT you are generating, it is not able to cover the interest properly. Like if you have 100 rupees, like say for example, you have 1 lakh rupees salary and you have 30,000 EMI, and either your EMI goes up like 50,000 or your salary goes down to say 80,000, what does it suggest? That the multiple in terms of EMI versus your salary is going down, which means it is very risky situation now. It might happen that you might get into accident and you're not able to pay that EMI. So the more the interest coverage ratio, EBIT by I, and I've covered this entire concept in ratio analysis formula. You can go through that later. I'm not going deep dive into that, but that is also giving you idea whether the business is improving or it is deteriorating. Cash flow from operating activity to PBT, it gives you idea around high quality, how the cash flows are getting converted. Again, I've covered this in financial statements blueprint. There is an entire module, go through that. And there is an entire Excel also, which you can use to, again, go through all these things. I've given my Excel screener, which you can just upload on screener and you can think about all these parts. But I'm not covering here because I assume that you've gone through it. If you're not gone through it, you can go through it later. That is perfectly fine. Then reinvestment of cash flow, because you need to keep compounding. We understood between business C and D, what is the difference, and action in terms of whether you are nearing 52-week low or 52-week high. What is the strength? What is the relative strength of the business? Also see the promoter holding, whether it is an increasing trajectory, whether they have a skin in the game. If they have like 10% holding, don't buy those kind of businesses. And whether the working capital cycle is also improving. And the size of the company will help you to also see whether they are on a sweet spot where that institutional buying activity is happening. Now, the bottom line, how to do it, right? That is what we'll try to quickly learn, and that is what will be your exercise also, which you need to do after this particular session. So you can go to screener and you can actually go to screen and you can just click on create new screen. Okay, so the first part is sales growth. So you just type sales growth. First, you want to see for medium term, like sales growth is at least, I generally prefer around 10 to 12%. Okay, so you can keep 10% as of now. Say 10% is the sales growth for 3 years. And then you want to also see the sales growth for like slightly longer period of time. So I want to also see for either 7 years or 10 years. It is up to you what you want to put it. So 7 years on an average, it has grown by 10% or 12% again. And if you want to see the improvement, you can also say like 3 years, if it is 12%, why not? Right? Then put end, then you see the operating margin profile. So operating margin, you want to see what is the trajectory. So I'll see operating. In fact, I'll do OPM this year is, greater than say 12%. Again, you can take 12%, 15%, anything about 12% is generally good. In terms of margin profile. And you also wants to see consistency, like 5 years, whether it is greater than at least 10%. And you are putting and, so that you want each and every criteria fulfilled. You don't want to like compromise on any part of the criteria. And later on, if you get very few companies, you can always tweak these criteria. I'm just giving you example how to go about it. You can apply your own head and do it. Okay. So that is how you have to go about it. And then you can go to the checklist and again see what is the next checklist item, which is ROCE and ROE. Again, you need to do both, like short term and long term. Why you need to do both? Because short term, you might just end up into a cyclical company. And if you do long term, it could be a banyan earlier and now it has become mango. So the overall average looks fine, but the near term, the growth is missing, the ROCE is going down. You don't want that kind of business. So you want actually the banyan kind of business, not anything which was banyan but now gone into mango. Okay, that is why we also see near term as well as long term both. Hope it gave you clarity. Now let's go to return on capital employed. So I'll say return on capital employed, like say last 3 years, it should be like greater than 15% and don't go below 15. Okay. This is like the minimum you should have. Then you can also do, return on capital employed for 10 years and so on and so forth. So you'll get say 7 years if you want to put 7 or 10, anything is fine. Okay, so you can take 15 years, 15 threshold over here. You can also put return on equity greater than 15. Then return on equity for 5 years greater than 15. Okay, and so on and so forth. You can say interest coverage ratio is greater than 3 times. Ideally, 3 times is good. Or you can also say return on interest coverage ratio last year versus this year is on improving trend. That also you can do. All those kind of permutation combination you can do as far as you are building on the logic which we have explained. Right? Then you can also do promoter pledging. Right? So what is the pledging? Pledge percentage is less than 10, less than 10% of pledging. Then promoter holding is greater than say 50%. I want not less than 50%. Also, you can say promoter holding is increasing, right? So change in promoter holding on an increasing trend, all those things you can try, is a lot of fancy stuff. Then another angle would be, say, probably think about your working capital profile. You can also think about those lines. Okay, that how the working capital profile is panning out. Then you can also do up from 52-week low, right? So it should be at least 25% up from 52-week low, so that I know that it is a strong company. Down from 52-week high, it should be at least less than 20% down from its all-time high or a 52-week high. Okay, so all these things which we have discussed in our journey, you can put it. You can also put it like debt to equity ratio, right? Debt to equity should be less than 0.5. If you are like too much risk averse, you can even tell, less than 0.1 or 0.05, almost minimal debt it should have. So all these things, it is again slightly individual specific, but this is how you can think about it. And also see cash flow from operating activities to PBT, right? So cash flow from CFO, you can type in, hopefully you should get it. Yeah, operating cash flow. Right, so operating cash flow divided by PBT for last 3 years. Average PBT if they are giving. Yeah, average EBIT also you can do. So that it's average EBIT you can do, and you can understand how they are going through the entire journey. So EBIT is, I think they have done for 5 years. So you can take numerator and denominator in same proportion and try to do it. Okay, so this is how you need to build the screen and then just run the query. I think I have not put something here like last end is not needed probably. Okay, so run this query and you'll get like list of companies. And if you get 2 lesser companies, ideally you should get at least 15 to 25 companies. If you get lesser companies, you can tweak some of these. Like I can tweak like say sales, I can make it like 10%. Say OPM, I can make it 10%. Those kind of tweaks you can keep on making. And ultimately you will reach to that stage where you can take a call. Like I can make down for 52-week low 30%, because market has fallen while we are speaking to an extent. What have we done? Yeah, this is 10. So this is how you can basically tweak, and now I'll get like 19 companies. So this is how you need to build the screen. And what you need to do is post the screenshot of this particular screen, what you are getting, the output you are getting. Just take a screenshot and post it in the comment section. And also whatever query, just copy paste this entire query which you have used and also post in the comment section. Okay, so that is what you need to do as a homework for this particular session. Hope it is super clear. And this is how we have busted the entire core portfolio, stock screening methodology. The satellite part which we discussed, that will happen in different parts of different modules, but hope this has given clarity.